What's going on, YouTube? 5 investment mistakes millennials make. And I'm a millennial, and these are some of the mistakes I've seen and some of my friends have done. So let's go into these 5 millennial mistakes and understand how to not get into these mistakes.
Millennials refers to the generation of people born between 1981 to 1996. The people of this generation are now 25 to 40 years old,
So that you will avoid them. So millennials are entering their prime earning years and are increasingly focused for building wealth.
Prime earning years for businesses, for business owners, or for anybody, at all. Your prime earning years are between 40 and 55 to 60. That's your.
This video reveals 5 common mistakes that millennial makes, offering valuable insights to actual tips to help you avoid these pitfalls and achieve their financial goals. So let's talk about it. Why should you listen to me, or why you shouldn't listen to me?
Imagine this. You finally made it. $1 million in your bank account. The cars, the mansions, the luxury vacations, it's all within reach. But then, something happens. One bad decision, and suddenly, it's all gone. Just like that. The house of cards collapses, and you're left picking up the pieces. Making money is one thing, but keeping it, that's where most millionaires fail.
Well, I'm not a financial expert. I'm just some guy on YouTube that does videos on finance, business, and everything else like that. I used to run a 7-8 figure company, and I've been investing in the stock market, real estate, and every else you can think. So I have very broad knowledge. Now, the reason why I think these 5 mistakes could ruin your life or make your life is because these mistakes is what I see commonly millennials will do, and it should not affect you if you don't make these mistakes. So the rise of millennial investors. Millennial is the largest generation in history that are entering their prime earning years. Yes, millennials are going to start making more money right now, more than ever, just because everyone's retiring. The boomers are getting ready to retire, getting themselves situated for retirement. So this is where you are going to start seeing great earnings if you're a millennial. This means they have more money to invest, increase focus in building wealth. This is the time where if you want a house, you want to do XYZ, you can start affording it, because the people who are millennials, they've been in the industry for 10, 15 years now and finished college, getting their debt paid down. And it's one of these things that, hey, millennials are getting a better situation. Yes, a lot of millennials are still out there doing random things and still messing up with money. But let's talk about the financially smart millennials, the ones with careers and everything like that. And they should be in a better situation. Now, this video will explore the 5 investment mistakes that people make in their investing life. Now, viewers need to know this pitfall. There's a lot of pitfalls, but what are the mistakes? Number 1 investment mistake is not starting early enough. The earlier you start investing, the more time your money has to grow, thanks to the power of compounding.
Let's assume a very generous bank offers to pay John and Lisa a return of 10% per year, and they each invest $1,000, called the principal. John wants to spend the interest each year and only keep the principal in the bank, while Lisa wants to save for 30 years, so she doesn't take the interest out each year. So his principal and the returns he made amount to $100 multiplied by 30, so another $3,000, a grand total of $4,000 that he made over 30 years. Lisa, on the other hand, will make more. After 1 year, she will have $1,100 in her account, but she keeps everything there. After the second year, she will earn 10% of those $1,100, and not only on the initial $1,000. Therefore, she will have $1,100 plus $110, so $1,210. 30. She will have $17,449.40, over 4 times more than John.
Yes, millennials keep holding off their investments for the retirement investment for the future because they need to take care of things now. You can't keep waiting right now. Millennials, you are at an age where you need to start taking advantage of the compound interest. Now, I understand you didn't invest in the 20s and 30s, but once you hit your 30s to 40s, you need to start investing so you can take advantage of the compound interest because it causes a big effect after you reach certain points, like above 100,000, and you'll start seeing that once you hit that 100,000, your wealth will dramatically increase. Now, this is especially important for millennials because they earn investing ahead of them. So if you don't take advantage of it, your time is gonna start dwindling. If you just start with a small amount and increase the investment over time, you will grow your retirement account. Don't wait. Investing waits for no one, business waits for no one, so you have to keep going. Now, if you don't understand this, you need to understand one thing. If you don't make any other mistake, you need to start investing. Um, 401k, at least do the bare minimum and do the match. That's what you should be doing right now. After that, do whatever you want with your money, but the bare minimum right now that you need to do if you're a millennial or anyone investing in any type of sort, millennial, Gen X, or baby boomers, I don't care what generation, the bare minimum, if you work for an employer, you need to do the match. That's free money. Do not let that slip away. Number two mistake, not diversifying your portfolio. Don't put all your eggs in one basket. Like, don't put all your eggs in Tesla or in just tech stocks just because they have great numbers, because you don't know what's going to happen. Don't jump in all in on real estate.
Mainly because they're higher risk and much more volatile, and you're much more prey to what if that was the company that was screwing around?
Yeah.
Then boom, you bet the whole dadgum farm on that one horse race, and that guy fell out. No, we're not doing that.
Even though you're making good money, real estate can take a hit. You need to diversify. If you put some in real estate, put some in the stock market. If you put all of it in the stock market, you need to diversify to something else in the portfolio. Now, you could just stay in stocks and diversify that way, but I tell everyone, if you want to be really diversify your portfolio, you need to get into actual real estate, a rental property, or a small side hustle, a small business, so you can diversify your portfolio. You selling stuff on Etsy, you selling stuff on eBay, all those stuff can make you money. So you need to diversify your portfolio while you're earning. Now, diversifying your portfolio across different asset classes such as stocks, bonds, real estate can help overall risk. So make sure you do your research and understand what asset class you want to allocate your investment in. I'm not saying go every single one, but you do need to start diversifying your portfolio. Now, what is the investment mistake number three? Is trading too actively. Now, the reason why I tell you this is investment is supposed to be a account where you just park your money and let it grow, and you pick a asset that you want in the stocks market or bonds, and you just let it sit there because you need to invest in high, guess what, you need to invest in high qualified companies that you are not scared to ride with, because every time you ride the market and you get scared or xyz and you're trading too actively because you're listening to someone on YouTube, at the end of the day, you need to stay in one company when you invest, or multiple companies. So pretty much you buy a company and you ride them with 1 year, 5 years, and you see how they do. After a 1 year investment, if they're doing bad and losing poorly, you can reevaluate and trade them then. But if you try to do it weekly, monthly, you're gonna end up hurting your portfolio, and you need to understand you are not a stock trader really. You're not a day trader. You might not have all this experience, and you will start losing money. I've seen people lose thousands of dollars are trading their stocks actively. They will max out their daily trade on Robinhood or something like that. And it's not good for you. You want to look for long term investments. This is why you don't want to make this mistake, because a lot of people make this mistake of trying to day trade, and at the end of the day, most day traders lose money. Now, over time, you will learn how to day trade, but in the aspect of being an active trader, most people lose money. Now, some people get mad that I say, hey, most day traders lose money. If you look up on the research, it's true. Most day traders lose money. And at the end of the year, when they do their books, the average one of them are in the negative. So most time I tell you don't day trade. It's not worth it. And actively trading is one of those things that you're just gambling with your money, and it's not worth it. Just pick long-term stocks that you believe in or a company you believe in, and stay in those companies and write it out to see understand why you invest in them. Now, number 4, letting your emotional drive your investment can lead you to irrational decisions. The one thing you need to understand about investing is you need to take your emotion out of it. Don't let your emotion cloud your judgment. Stick to your principle and your investment plans. And write out market fluctuation, because the market will jump up and down. You don't know what president's going to be in office, what they're going to do, and it can affect the stock market. But then one day it could drop 200 points, the next day it jump up 500 points. No one really knows, but at the end of the day, write it out. And because the stock market, real estate market has an upward trend throughout history. So if you write it out long enough, it will have an upward trend. Just don't let your emotion or anyone influx your trading or investment life, because at the end of the day, it's your money. They're not going to really care, and you need to pick and be disciplined on your trading or your investment, because if you really believe that that house was a good investment, stick with it. If you really believe this company you invest in is a good company, stick with them. Write it out and understand that why you made that decision based off the information when you purchased. Maybe they were getting into let's use a mining company. Maybe they're just purchased 10 mines and they're negative for 2 years to buy new equipment, to buy all this stuff. And you knew this, but you didn't know that it was going to hurt the stocks and it's going to drop the stock price. Well, don't panic. You knew that they're going to have to make some investment. And then the third year, they jump up 200%, 300%, just because now they're making a lot of money because they passed the growing phase pain. So understand, don't let your emotion drive your investment. Use logic and knowledge on it. Number 5 investment mistake is not seeking professional help. Now, even experienced investors like me get guidance from financial advisor every once in a while. And this is someone that's either works for a finance company or something like that, and they understand the market better than me. And mainly when I go to these companies or ask the financial advisors, I ask them to do more due diligence on a company for my personal expert, because they're going to have access to more information more readily than me doing research on the internet, and their research is going to be more reliable than my research. So I tell you, not seeking financial advice is probably a bad thing. Don't look for financial advice on the internet. Look for financial advice, someone that can help you look to the stock that you want and make the right decision. Now, financial advice can help you develop and personalize your financial planning and diversify to how you want to invest. And this is what financial advisors can help you with. Now, I don't really like paying for it. I use a free one, and I go up to Fidelity into their office and say, hey, I want to know more about XYZ stock. Can you get me the information? They just email me it. They give me all the investment information, and it costs me nothing. So I do use it for that aspect whenever I get really interested in putting a lot of money into certain stocks. So like and subscribe to my video, comment down below. But those are the 5 investment mistakes I see millennials make. Like, subscribe to my video.